780 price target from 455.
You feel his pain?
Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So big news overnight. Goldman Sachs have upgraded Tesla stock by an absolute shit ton, increasing their price target by over 70% to a street high $780 per share. All I can say is, it's about time. Now, in their defense, most analysts on Wall Street have had no idea about Tesla for a number of years now. Goldman Sachs are finally starting to get it. Even so, in the latest notes relating to this price target change, this upgrade, they're still extremely conservative in their estimates, in my opinion. So in this video, I'm going to go through a few highlights from the research report and add my thoughts and opinions where I think it's relevant. So let's get into the video. But first, hey guys, if you live in the US and you'd like to help out the channel and get up to 4 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 2 free stocks between $2.50 and $250 each just for opening an account. And if you deposit $100, you'll get a further 2 free stocks valued between $8 and $1,600 each. That is an obnoxiously good return on your investment. I mean, really, deposit $100 and you'll end up with, at minimum, $21 worth of stocks, a 21% ROI on your money. And if you're in Australia, the UK, or New Zealand, you can get a free stock with stake also using the link in the description. Let's get back to it.
How do you value it? David, you know some of these companies, like Tesla. How do you value it?
I don't know. When it comes to Tesla, I don't know. Let's do a DCF valuation, assuming 15 million units in 2040. And therefore, after that, we have Tesla entering perpetuity growth of 2.5%. That's Goldman Sachs' estimate of how you analyze and try and assess the value of Tesla. And that's how they get to that 780 price target from 455.
You feel his pain?
This is really funny to watch. I mean, I thought I was disrespectful towards the Wall Street Muppets, also known as analysts. Now, no disrespect, but I mean, if somebody is completely fucking wrong to the point where it's embarrassing, I am going to call a spade, and that is exactly what has happened on Wall Street. No one's understood Tesla. We have to be honest about this. Goldman Sachs now, despite the fact that it's laughable because the upgrade's gone from $455 like a month or two ago now to $780, they're actually on the right track now. I think there's actually going to be a lot more analysts on Wall Street in the coming months and potentially years having the exact same experience, doing a massive, enormous upgrade on Tesla stock, doubling their price target when they finally start to get what's actually going on. Now, I don't want to be too much of a douchebag here, but I'm just calling it as it is. Wall Street at this point in time doesn't know what the fuck they're looking at when they look at Tesla. We're now starting to see some of these firms, some of these analysts go, oh, that dickhead on YouTube that once insulted me actually might have had a point. Not that they actually watch YouTube, otherwise they all would have quadrupled their price targets a year ago, right?
Yeah, he downgraded the stock in June. By the way, you can't blame anybody for downgrading, and when it comes to Tesla, I don't think it was. But it's been up 192% since the downgrade versus the S&P, up 22%, which, by the way, has been pretty darn good. That's since the middle of June when Goldman made the mistake of downgrading Tesla, only to upgrade it today on better long-term sales outlook and margin expansion, Jim. Their EV adoption case scenario keeps going up. They call for 26% global EV adoption by 2030, 40% in 2035.
Oh boy. I mean, hey, look, it's progress in the right direction, but this is embarrassing. And I'm sure in 10 years' time, Goldman Sachs are going to want to facepalm through the back of their skull for being so conservative on their EV penetration estimates. 26% of new vehicles will be EVs in 2030. Try tripling that and then some, and I think you'll be closer to the mark. But hey, at least they're moving in the right direction.
I know. I mean, it's painful because then he had to stretch it to the EV, more adoption, the battery, the margins getting better.
And then also full autonomous.
Yeah, but wouldn't it have been better just say, listen, he did say that I got it wrong. That was, I mean, it is a mea culpa piece.
Yeah.
But at the same time, I think that what the people who read it make judgments about his credibility going forward because, David, there were finances, including by Goldman. And maybe they needed to bring back, David, the Chinese wall. Remember the Chinese wall where the analysts listened to the corporate finance? And I mean, that's what he needed. He needed to listen to corporate finance. They had to slip him the note saying, listen, going higher. No, the Chinese wall defeated this.
Right. Your point being, if you talk to the guys on the corporate finance side, you would have had a more bullish outlook.
Yes, because they priced these deals in 5 minutes.
And everybody would line up to buy.
But the analyst was so pure.
Yeah.
What a shame.
Now, for those of you who are completely confused by what Jim Cramer is getting at here, let me sum it up for you. Jim is implying and suggesting that this analyst was a very good boy and didn't do anything illegal, which may or may not happen at other firms in which the analysts and the sell side kind of have some conversations behind closed doors, which they should not have. For example, you'll sometimes see an investment bank buying up a huge position in a stock while at the same time, because of this Chinese wall, no communication, that's very naughty, the actual analysts are suggesting people sell the same stock. This is what he's referring to. Now, Jim Cramer has in the past given some very, very salacious details into how hedge funds manipulate stocks. I'll put a card in the corner. Highly recommend you guys check out that video to get a bit more of an understanding of some of the sketchy stuff that may or may not go on in these funds, in this world of stocks. But the point he's making is this. Had this analyst simply had these discussions illegally, he may not have been so off the mark regarding Tesla. Let's just leave it at that. But wait a minute, Stephen. What if he did have the conversations and that's exactly why there was a sell rating on Tesla stock? Is it possible that sometimes in some of these firms, maybe these discussions do happen, and while one half of the company is buying the stock, the analyst is saying you shouldn't buy the stock? That might keep the price down. Is that possible? Now, I'm not making any allegations here or anything. I just was thinking out loud. But yeah, you guys really should watch that video when Cramer talks about how hedge funds manipulate the stock market. Yeah. Moving right along. Now we're going to look at some of the highlights from the Goldman Sachs note regarding the Tesla stock price upgrade. We are upgrading Tesla to buy from neutral and raising our 12-month price target to $780 from $450. Given that we believe the shift towards battery electric vehicle adoption is accelerating and will occur faster than our prior view, I'm just jumping in here. This is going to be the same comment repeated over and over and over from practically everyone on Wall Street over the next 12 months. Mark my words. We believe that battery prices are falling faster than we previously expected, which improves the economics of EV ownership, and there has recently been an increase in regulatory proposals from some jurisdictions to limit or ban the sale of new internal combustion engine vehicles entirely in 10 to 20 years. We are raising our outlook for EV adoption and now expect EVs to comprise 18%. Fuck, I can't do this. I'm sorry, guys. I'll try that again. Oh, breathe, Stephen. All right, let's try that again. We are raising our outlook for EV adoption and now expect EVs to comprise 18% of sales globally in 2030 and 29% in 2035. I have to jump in here. This is just going to be absolutely catastrophically embarrassing in 10 years' time. 18% of new EV sales globally 2030. Try 80%. Anyway, let's move on. We also believe that the momentum behind EVs from both an economic and regulatory perspective is leading to a higher probability of our upside case EV adoption scenario that calls for 26% global EV adoption in 2030 and 40% in 2035. Once again, I have to jump in here. This is their upside case, as in like this is kind of like a bullish case, and they're thinking 26% by... oh, guys, please, please, please. I'm telling you now, worst case scenario, 75% of new vehicles in 2030 will be EVs. Worst case scenario. That is the worst case scenario. Oh, all right, let's continue. Importantly, we expect that Tesla's integrated model, including its coupling of custom hardware and software, platform approach with significant parts overlap between key products like Model 3 and Model Y, and its ability to offer a full ecosystem of products for consumers, including solar, storage, and convenient access to fast charging, will help it sustain a leadership position in the EV market. Yes, 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 and yes. If Tesla sustains its mid to high 20% range share of the EV market, then it could reach 15 million units by 2040 and about 20 million under our upside case EV market adoption scenario. To the extent that the industry continues to shift towards EVs more quickly than we anticipate, jumping in here, it will. Or if Tesla is able to take share in the market, then we believe that there is a possibility Tesla reaches these types of volumes more quickly. Yep, here's my prediction. Tesla around 20 million units per year by 2030, base case. Our DCF valuation assumes about 15 million units in 2040 when we have Tesla entering perpetuity growth of 2.5%. We believe that the energy and full self-driving software businesses could be more valuable than we previously thought. once again jumping in here, they're right, and once again, this is what every other analyst will be saying in their upgrade notes as well over the next 12 months. The energy business should also benefit from the regulatory shift towards carbon reduction and clean energy, and solar market valuations have similarly accelerated. In addition, our full self-driving valuation analysis could be toward the higher end or above our prior expectation, as the larger auto sales opportunity should lead to a bigger installed base of cars for Tesla to sell software for. Bingo! We expect margins to expand, driven by the mix shift towards the Model Y, which has well above corporate average margin potential given the more than 75% parts overlap with the Model 3 and higher price for the Model Y than the Model 3. In addition, the increased mix of software sales should also be a tailwind to margins over time, although if Tesla adopts a subscription model for full self-driving, then this could be a temporary headwind to full self-driving related revenue and margins. When we downgraded Tesla stock to neutral from buy in June 2020, despite our positive view of EV adoption in the long term, we had been concerned about a potential slowdown in demand as Tesla had lowered prices more than we expected. Now, I hate to be that guy. Actually, you know what? I don't. I am that guy. Those of you who've been watching the channel for a while will recall very distinctly this guy saying words to this effect. During the pandemic, I said, now we're finally going to get proof, unequivocal proof, that Tesla's demand far exceeds their ability to supply. Obviously, less people buying vehicles, yet still they will sell every one they make. And what happened? Exactly that. And while I'm up on my high horse throwing disdain and disrespect towards the Wall Street analysts who've been completely fucking clueless and wrong, by the way, it's nothing personal. I'm just here for the truth, the facts, and the information. And you guys have been so fucking wrong that you need to be absolutely eviscerated for it. At the same time, I've been saying for literally 12 months that Tesla will continue to reduce the prices of their vehicles as they can, as they drive their costs down. They will pass those on to consumers, not because they need to spur demand, but because their mission is to accelerate the world's transition to sustainable energy. And that means they need to get the prices of their products down so more people can access them. I hate to be so obnoxious, but dear any Wall Street analysts who are watching this video, the next time you have a question about any aspect of Tesla's business or why they've made a decision, please refer back to their mission statement. That will probably answer your question. You won't need to panic or worry, think, oh no, there's no demand, that's why they're cutting prices. You'll think, well, hang on a minute, wait a minute. Wait, that's right. Their mission is to, so that means that if they're cheaper, then more people can buy them, and their mission, I get it now, I get it. So here's a little bonus pro tip. If in the future you ever hear anybody implying that Tesla has cut prices on a product because they needed to, because there was insufficient demand, you know without a shadow of a doubt you are talking to somebody whose opinion is absolutely worthless. This concern that we had about growth slowdown was incorrect, and since our downgrade on 6/11/20, the stock is up 192% versus the S&P up 22%. Tesla's results were above our expectation for each of its last two earnings reports. And I have to jump in here again. I mean, I sound so incredibly arrogant, but it's just because I've been so incredibly right. I've been calling this for consecutive quarters now. Tesla will beat analyst expectation over and over and over. Wall Street still doesn't understand Tesla. They still end up completely confused, baffled, and surprised every quarter. This is going to continue for some time. People just cannot fathom the insane rate of growth. And we now believe that the price reduction for Tesla vehicles was driven primarily by improved cost at Tesla that was being passed on to the market. Yes, bravo, bravo, bravo. You are right. Better late than never. Going forward, we expect the company to drive strong growth in Model Y sales as it ramps 3 new factories, Shanghai, Berlin and Austin. And we are also now more positive about the long-term opportunity in both automotive and energy. Yeah, remember how Elon said that energy is likely to grow to be about the same size as the automotive business? Yeah, enormous opportunity lies ahead in energy. It's good to hear this being mentioned in this note. Even though the stock has significantly risen year to date, if our revised expectation for material upside to street estimates and ongoing regulatory momentum for EVs and clean energy is correct, then we believe that the stock can outperform. And so does this guy. So now we're looking at their revised delivery estimates, which have increased to 500,000 units this year. I think they'll be correct. 850,000 units next year, way too low, boys and girls, and 1.05 million units in 2022. Now, I hate to be so obnoxiously direct, but once again, this is going to be incredibly embarrassing in 12 months' time. Tesla will deliver around 1 million vehicles in 2021, not 2022. Their 2022 deliveries will be like 1.5 million, give or take, maybe more. Again, I don't know, I don't have any proof, But I do have a brain and am capable of looking at their current facilities, their ability and pace to ramp up new production. We've got an example there of Shanghai. We can see how fast the Austin and Berlin factories are coming together. I mean, Austin is being constructed now with 24/7 shifts, okay, non-stop construction work. I've got a funny feeling that both of those facilities will be producing many, many tens of thousands of vehicles next year, and by 2022 they'll be ramped like crazy. Again, I could be wrong, but hey, please keep me accountable. Set a reminder for like 13, 14 months from now, and let's check back in. Tesla's going to deliver closer to 1 million units next year than 850,000. Mark my arrogant words. Our delivery estimates for 2020 to 2022 implied that Tesla would have a mid to high 20% range market share of the global EV market in the next few years, which is similar to its current share. Now, I'm actually going to jump in here and say, well, it is possible Tesla may maintain approximately a 20% share of the global EV market. It may fall because everyone, except maybe Tony Seba and the folks over at ARK Invest, are completely underestimating how quickly EVs will become the dominant form of new vehicle. This is an S-curve adoption rate, disruptive, innovative technology. This isn't going to be incremental improvements. So the whole market is exploding. Now maybe Tesla can ramp their production to maintain that market share, but it's not guaranteed. But in either case, these numbers based on a percentage of the market share are completely off because they think the market's going to be a speck when it's going to be absolutely colossal. Once again, just for a little bit of fun, guys and girls, maybe take a screenshot of this just to troll Goldman Sachs and the entirety of Wall Street in a couple of years' time. We've got Wall Street looking at 750,000 deliveries in 2021 from Tesla. Like, that's it? Are you serious? Do you guys not understand how quickly Shanghai is ramping, that ultimately it's going to produce 1 million vehicles per year, that Berlin's capacity is 2 million vehicles per year, that Austin's going to be a monstrosity of a factory as well, and we have proof, evidence of how quickly Tesla can ramp up their production facilities. We're seeing this happen right now. Like, just think. It's not that difficult. I know it sounds crazy that a company this size could possibly scale that fast, but get past your preconceptions and look at the data and the evidence before our very eyes. Again, this is nothing personal, but we have to call a spade a spade. These guys are absolutely fucking clueless. 1 million in 2022? Oh my God, dude, just give up. Just give up. Just give somebody else Tesla to cover, okay? So I hope you guys have found this video insightful. Now, I just want to be very clear here. I think Goldman Sachs now get Tesla more than the vast majority of the other analysts on Wall Street. But even so, they're still underestimating Tesla enormously. I think over the next 12 months, we're going to see every analyst one by one systematically upgrade with the same kind of reasoning. Oh, there's more EV demand than we realize. Oh, the EV market's growing faster than we realize. Oh, Tesla's margins will keep improving. Oh, Tesla isn't reducing their prices because there's no demand. They're doing it because they're driving their costs down. Oh, this energy business is actually a thing. Oh, this software component is actually a thing. Oh, Tesla can actually ramp facilities way faster than any other automaker we've ever seen because, they're not really an automaker, and wow, we should probably consider that in our estimates rather than just assuming they're like GM or Ford and can only incrementally increase their production year over year. So the point of this video is quite simple. At this point in time, the Wall Street analysts, the overall consensus, still completely clueless when it comes to Tesla. And in my opinion, that creates an enormous buying opportunity. As a long-term Tesla stock investor, I'm still buying the stock with every spare cent that I have. I know these buying opportunities won't last forever. Eventually, the tide will turn. But until then, smells like opportunity. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. And don't forget, if you live in the US and you'd like to help out the channel and get up to 4 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 2 free stocks between $2.50 and $250 each just for opening an account. And if you deposit $100, you'll get a further 2 free stocks valued between $8 and $1,600 each. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake also using the link in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.